Hey guys, Kylie here. So Robinhood just went public on the NASDAQ. I thought it was a really interesting case study, so I wanted to share some of my key learnings from this IPO. And I'm also going to talk about why I think you need to be really careful before you invest and some of the big risks. Plus, I'll be revealing my own course of action when it comes to Robinhood, so stay around for that. And I interviewed an investment analyst and ex-stockbroker for her views too. And just as a heads up, I'm based in Sydney, Australia, and we're in the middle of a lockdown right now. So, if this video recording doesn't go as smoothly as it should, well, you know why. Okay, so just a basic summary of what's been going on. Robinhood is a super low-cost US stock, options, and cryptocurrency trading platform. Because of this low barrier to entry and the fact that its platform is designed to target a younger generation of investors, it's become really popular with the millennial-esque Gen Z FinTokers of the world, Wall Street bets types. So of course, all that volatility leads to the question, is Robinhood a buy or is it a short? Well, I think some of these points will help to explain my views. Okay, so before I go on, don't forget to hit the like and subscribe button if you like this video and want to see more content, and feel free to leave comments in the section below. Okay, so I think the first really important question you need to ask before you invest in any company, not just Robinhood, is how does the company make money and is it sustainable? Basically, Robinhood uses a payment model called payment for order flow. So it's been around for a couple of decades now, but it's particularly picked up steam again in the press because of the GameStop period, where people started scrutinizing how Robinhood was making money, why it decided to halt trades on GameStop and other meme stocks at the time. Okay, so let me just run through the steps of how payment for order flow works. Okay, step number 1, a user makes an order on Robinhood. It's like a buy or sell order for a stock or other type of asset like a ETF. Step number 2, Robinhood sells that order off to an external third party, a market maker. These would be like a hedge fund or an investment bank. That market maker will then execute the trade. At the same time, the market maker can use that data to trade profitably against the client orders. The market maker will then pay Robinhood fractions of a penny to sell off that order. And that amount is presumably more than what the trader has lost and less than what the market maker has made. And you can see here in the SEC filing that Robinhood made 74% of its profit or its revenue from the payment for order flow model. 34% of that came from the market maker Citadel Securities, followed by other groups, including Wolverine Holdings, at around 10%. If you think the payment for order flow model sounds kind of dodgy, well, you wouldn't be alone. A lot of other people would agree with you, and even a bunch of regulators agree with you. For example, the payment for order flow model is banned in Canada. It's also banned in Australia as of 2014. The UK has also put the payment for order flow model under review, and in fact, a lot of brokers that work in the UK no longer allow that model. I think the really key thing here is that all of these bans in overseas markets means that Robinhood essentially can't expand. It's very reliant on the US market so long as regulators continue to allow the payment for order flow model. And you can see here that Robinhood has actually highlighted this as one of its key risks. And seriously, I would agree with that. The payment for order flow model has also already landed Robinhood into hot water multiple times. I actually reached out to some people on Twitter just to find out what they thought about Robinhood, whether they would be going long, why or why not. And one of the points that was brought up at least a couple of times was the payment for order flow model. One person that did reach out was Danielle Ecuyer. She shared with me a really interesting report talking about the payment for order flow model and why Robinhood uses it. And she also shared her thoughts on why she thought the company was basically unethical in using this model. So I thought I'd grab her to have a chat about what she thought Robinhood's main risks were and what she thought of the business model that Robinhood uses.
When you think about it, so all your users, you are selling the users' data, which is obviously what Google and Facebook do. And that's the comparison that some people have given me. Well, all the other companies do it. Why can't Robinhood do it? Yeah, but the point is that they're selling the data that the other big institutions then trade off. So it's almost like they have an inside running. I'm not going to say insider trading, but if they see what's going on one side of the fence, well, they can form a view and say, well, we might take the other side. And obviously you've kind of seen that with the hedge funds and GameStop and AMC and things like that. But I don't know. I think that too many people have the propensity to be really, really badly burnt with this model. That's my personal view. But equally, I get the other side of the equation, which is people saying, we want those millennial dollars. We want those millennial eyeballs. We want the Gen Zs. And if they're going in that direction, we're just going to jump on that gravy train. Never underestimate the ingenuity of people in the finance industry to provide new products to attract new money. There is no end of invention. I'll try this will be new. You know, Wall Street and anyone associated where they can see money to be made, they will be as creative and push the boundaries as much as the regulators will allow them to.
Do you think Robinhood's at risk of being another GameStop or a meme stock?
Potentially, yeah. And we've seen a lot of bubbles like that. And I think you will continue to see them. That is until you see some withdrawal in terms of liquidity from the Federal Reserve and central banks. And I think investors have to be really, really careful of stocks as they go into this bubble space, because momentum traders come in and other traders come in. So as much as people might poo-poo fundamentals, when a company completely dislocates from reality, which happens, you know it's only got one way to go, and that's usually to your detriment.
So I think the biggest takeaway for me here is that you need to always understand how a company is making money, especially if it is using some kind of zero fee or zero brokerage model. Do you understand how it makes money? Do you understand the business model? Do you think that business model is sustainable? Like in the case of Robinhood, its payment for order flow model is clearly under scrutiny even by US regulators, and it's clearly a risk for the company moving forward. That kind of brings me to my second point, which is the company doing good by its customers and even the world? How a company behaves, how its CEO behaves, and whether the company is ethically aligned with other people's values is becoming way more important than it was before. On social media, one of the biggest criticisms that you see about the company is that they don't trust the CEO. They don't trust the business. They don't think the business is doing good by its customers. It's accused of rolling over its customers for the pursuit of profits, which is never a good look. Another really big criticism of Robinhood is that it promotes itself to young and inexperienced investors, and at the same time, it exposes, in fact, encourages them to trade pretty high-risk options. Robinhood have been criticized for essentially gamifying the investment process by offering rewards for buying stocks and having a minimalist design that encourages high volume trading as opposed to long-term investing. In fact, US regulators in 2020 of December filed a complaint against Robinhood, citing its aggressive tactics to attract inexperienced investors and its use of strategies such as gamification to encourage and entice continuous and repetitive use of its trading application. And of course, we all know, thanks to its business model, that it relies on those high frequency trades because it makes money for every transaction that somebody makes. Funnily enough, Warren Buffett has actually weighed into the debate. He's criticized the casino aspect of the stock market. He says there's nothing illegal about it, there's nothing immoral, questionable about it, but I don't think you build a society around people doing it. So I think one of the big questions you need to ask before you invest in any company is, does the company treat its customers well? And does it treat the economy or the planet well? If not, that could come back to bite its shareholders. And that kind of brings me nicely to my next point, which is social sentiment. Robinhood is a massively popular stock amongst younger Gen Z, Gen Y investors. We already know that a lot of investors in Robinhood are retail investors because Robinhood specifically said it would allocate up to 35% of its IPO stock to its users. So in my view, the popularity of the stock combined with the number of retail users that are also on Wall Street bets puts Robinhood at severe risk of becoming a meme stock or creating a herding event, which is what we saw during GameStop. Basically, a herding event is when, there is a sensation created around a stock, which brings a whole bunch of other investors into the market to either buy or sell the stock. A small number of investors will influence a large number of investors. The other key factor we need to think about is social sentiment, like how the company is perceived by the market and by retail investors in the market. The GameStop saga is the one that comes to mind really quickly because, the company was not doing well. Its profit numbers were going downhill. It didn't seem to have particularly great growth plans, at least that's what a lot of analysts said. But still, its stock price surged by, I think, 1,000% last time I checked. Maybe it's 3,000%. And if you don't think social sentiment is important, well, a massive fund manager in the US, Van Eck, now provides a social sentiment ETF, which says it holds stocks like Tesla, GameStop, and Nvidia based on the 75 stocks with the most bullish social media sentiment. And I was just looking at the numbers the other day and they're not looking too bad. And more we're seeing that social sentiment scores have a really strong correlation to a stock's price, depending on the stock. If you look here at swaggy stocks, and you can see here the stock price correlation to those negative or positive comments on Wall Street bets specifically. So this is quite targeted, but you can get other social sentiment scores which tracks the broader market in general, like news services, Twitter, Wall Street bets, yes, but also other forums. Okay, so the big lesson I think here for me is that hedge funds can deny it all they want, but social sentiment is a massive indicator of stock price performance. That's something to take into account before you invest in any company these days, in my opinion. My next point is that investing in IPOs can be seriously risky and unpredictable, either investing ahead of the IPO or post-IPO for at least the first few weeks. This is because in the lead up and the weeks following an IPO, there's a lot of hype, both from the company, which is marketing its IPO, and from people just on social media and in the news. Just as we talked about before, both social media and news can have a massive influence on a stock's price, which makes it particularly volatile around the IPO time. For example, Coinbase, which was another massively talked about IPO at the beginning of the year. It's a cryptocurrency exchange. It is now down by around 30% so far this year since its listing, despite massive expectations and despite cryptocurrency being a pretty big play this year. In fact, at the company I work at, Finder, cryptocurrency has by far been the standout performer on the website. Even I was drawn in to buy up Coin just after it listed on the stock exchange, a move I've now come to regret, I guess, to a degree. I mean, I only invested what I could lose, but it just goes to show. And I think it's kind of relevant here because similar to Robinhood, Coinbase makes money by the number of transactions that take place for cryptocurrency trading. And, with cryptocurrency sort of slowing down, you can expect that Coinbase's stock price will also potentially drop. And we could see the same thing with Robinhood if stock trading starts to ease. Okay, so the lesson there is pretty clear. Betting on an IPO is pretty risky business. Even buying ahead of the IPO, which is targeted as being a discount price, you just don't know what's going to happen in the weeks following. I think my final point kind of summarizes everything I've been talking about so far, and that is that investors these days behave very differently to investors of the past. Like in the last few years, we've seen a major shift in the investing landscape, and that's partially due to this rise of low-cost investing apps such as micro-investing apps and zero brokerage brokers, which make it a lot easier for younger investors and people with a lot less money to start investing in the stock market. And a lot of these investors have come into the market at a really volatile time. In 2020, it was the most volatile year on record. And I think the trading behavior of these new investors is indicative of that. They're more active traders than long-term investors. They've also entered the market at a time where interest rates are at record lows, which means that keeping your money in the bank gets you next to zero return on your money. That means if your cash is sitting in a 0 interest or 0.1% return account, your money could actually be going backwards. This has seen more people move their money from bank accounts into the stock market. They're willing to take on that extra risk for a chance at making some kind of return. I think another really important point about this next generation of investors is that they're a lot warier of financial institutions and financial products than the previous generations were. They saw what happened during the 2008 GFC, where a lot of older generations were basically screwed over by the big institutions. So I think there's this inherent distrust, and with that comes a demand for much greater transparency. And to be honest, with Robinhood's payment model, I think that puts the company at risk. So I think to summarize that lesson, throughout history, different market conditions, new generations, and new technologies have changed what it means to be an investor. And Robinhood and its popularity among younger investors is a perfect example of history in the making. That being said, new investors should approach these changes with caution as well as curiosity. Okay, I said at the start that I'd talk about my own approach towards investing in Robinhood, and I think it's pretty clear by now that no, I did not invest in Robinhood stock, and I don't intend to buy up Robinhood stock in the future. The main reasons are just some of the points that I've highlighted throughout this video. Aside from being not very transparent and potentially unethical, morally ambiguous, it also hinders its growth plans to other markets, and it's also at risk of regulation. I also think that Robinhood is really reliant on continuing to promote to new and inexperienced investors. And I think more and more there's just so much information out there about how to make good trading decisions, why you shouldn't use market orders, that this business model might become less and less productive over time for Robinhood. Robinhood's platform is super minimalist. It doesn't offer much help in the way of making good trading decisions. There aren't very good technical analysis charts, there aren't analyst reports, and it doesn't offer a good list of conditional order types. It's super basic and it doesn't help you make a good decision. In fact, to me, Robinhood's platform is designed to help you make a poor decision that will gain Robinhood more profit. What kind of risks that entails? To me, Robinhood is at higher risk than many other stocks. And the final point is that I already burned myself with the Coinbase IPO, so I promised myself I wouldn't do it again this year. So yeah, stayed clear of the Robinhood IPO. Okay, so that's it from me today. Those are 5 big takeaways that I got from the Robinhood IPO. I hope you enjoyed them. Did you agree with them? Did you disagree with them? Are there any other lessons that you found from the Robinhood IPO? I'd love to hear about them in the comments below. And if you like this video, don't forget to hit the like and subscribe button for more videos just like it. Thanks for watching.